Good morning, everyone. This is Stuart. Hope you had a great weekend. This morning, we'll cover the latest on the trade conflict, the market's recovery, Warren Buffett stepping down at Berkshire Hathaway, oil markets, a major move in the Taiwanese currency, and a few earnings takeaways. Are we past peak trade fears? Hopefully, the answer is yes. China and the US are now at least talking, which is a vast improvement from where we were several weeks ago. The market has been rallying on hopes that the US and its trade partners make progress. Supposedly, the US and major trade partners are close to announcing frameworks for future agreements. The market, up until this morning, has had a 9-day win streak, which is the longest in about 20 years. During that streak, the S&P is up about 10%. That's the best performance for a 9-day win streak on record. The index is now back above its April 2nd Liberation Day tariff announcements. The forward multiple on the S&P has recovered from about 18 and a half times forward earnings at the trough several weeks ago to now 21 and a half times forward earnings, which is the best level since February. Is everything in the clear? Remains to be seen. Some of the manufacturing data has been coming in weak, as have the surveys. Container bookings from China are down about 40%. We've also seen weakness in trucking data. Even if all the trade chaos went away overnight, there would still be probably several months of disruption that shows up in supply chain data. So we'll just need to pay attention to economic data over the coming quarter or two to see how much damage has been done. It's the end of an era at Berkshire Hathaway. Warren Buffett announced his retirement over the weekend. He's handing over the reins to Greg Abel, who ran Berkshire's energy business. The gains that Warren Buffett presided over at Berkshire are unlikely to be matched by anyone anytime soon. 60-year compounding at 20% versus the S&P at 10.5% resulted in a 5.5 million% gain for Berkshire shares, which blows out the 39,000% rise in the S&P 500 index. Greg Abel will have to decide what to do with Berkshire's $350 billion of cash on the balance sheet. Will they announce an acquisition or perhaps return cash more aggressively to shareholders going forward? There's been weakness in the oil market. OPEC surprised the market by announcing a production increase of about 400,000 barrels a day. It's unclear if this is to appease the Trump administration, which wants lower oil prices, or perhaps to punish fellow OPEC members who are producing above their quota levels. In any case, oil in the 50s is not fantastic for U.S. producers. They're still profitable at these levels, but it's unlikely that drilling activity will resume at the pace that it was at last year. Perhaps counterintuitively, when oil drilling in the US declines, that's pretty good for natural gas. Natural gas is a major byproduct of shale oil production. If there's less of that, it's a tighter natural gas market. Natural gas also is benefiting from demand in the AI and power space. So in the energy complex, we do prefer natural gas over oil-related names at the moment. Taiwan has had a major move in its currency against the US dollar, the biggest move in several decades. It's appreciated about 10% over the last week. That impacts Taiwanese exporters such as Taiwan Semiconductors, which makes chips for NVIDIA and Apple and others, making their products more expensive for US importers. There's speculation that perhaps Taiwan is appreciating its currency to appease the Trump administration ahead of any potential trade talks. We'll need to see what the ramifications of this are going forward. In the earnings space, lots of companies reported over the last week in tech and on the consumer front, in finance as well. In tech, the theme was and continues to be artificial intelligence. Lots of great commentary from companies in the space. Amazon said, demand is outpacing supply. We simply cannot build AI fast enough. From Microsoft, we now expect to have some AI capacity constraints beyond June. Alphabet said, in cloud, we're in a tight supply-demand environment. And Meta said, we're having a hard time meeting the demand that teams have for compute resources across the company. They're referring to satisfying demand for GPUs, both internally and externally. There was a lot of concern going into the quarter that tech companies had perhaps overbuilt in the data center space and were spending too much money that was not going to generate returns. Well, we've seen that companies are generating returns, and what's stopping them from generating even more returns is the inability to build data centers and get chips fast enough. So all the companies in the AI complex actually reiterated their capital expenditure guidance for the year. In some instances, even raised it. This is very positive for any company in the artificial intelligence infrastructure complex. On the consumer front, it was a bit more mixed. McDonald's reported a sales decline. The airlines had weak earnings and actually pulled guidance. Amazon's retail segment was actually a bit weaker, and Apple had some trouble in the US and particularly in China's market. Quickly, with respect to Apple in China, we are paying attention to their supply chain risk. Apple announced that they're going to move US iPhone production to India beginning as soon as 2026. We think that's probably easier said than done. Apple perhaps remains uniquely exposed to US-China trade risk. We think these risks are navigable and would be part of any US-China deal. We think Apple fundamentally is in good shape. But the supply chain issues are worth watching as part of these trade negotiations. If you have any questions on the market or any stocks in your portfolio, please feel free to reach out. Thank you very much and have a great start to your week.